Good morning, everyone. It's the 1st of November, the summer is just around the corner, but it's time to have a look at the third quarter of 2024 in our quarter review. With me, I've got Nick Downing, CEO and Chief Investment Officer at Overberg Asset Management, that's going to present to us today. For those of you that don't know Overberg Asset Management, just in short, our vision for our clients to live a life beyond wealth, entrusting us with safeguarding their financial well-being. So on the agenda today, first up, we're going to look at global economic and market review. So looking back at the quarter, we're going to look at economic and market expectations, so looking forward. Then next, we're going to look at projected asset class returns. And after that, we're going to look at the OAM global portfolios and how we fared. And lastly, we're going to summarize all of that up. Well, without further ado, let's get right into it. Over to you, Nick.
Thank you very much, Carel. It's a great pleasure to be back again presenting. The format this time round will be slightly different. We're going to make the presentation a little bit shorter, so we should have it all wrapped up within 30 minutes. So let's start off then with the economic and market review. The bull market in global equities is entrenched, as we can see from this chart here. The global equity markets fell in July as enthusiasm for AI-related shares waned, reflecting doubt over the sustainability of their earnings growth. Stock markets have recovered since then amid strong second quarter earnings and with the prospect of central bank interest rate cuts. The US S&P 500 index recorded a brand new high in September, an all-time record. The Federal Reserve began its interest rate easing cycle with an outsized 50 basis point rate cut, although the pace of rate cuts is expected to slow to 25 basis points increments in upcoming monetary policy meetings. In total, we forecast 175 basis points of further easing, taking the Fed funds rate to 3.25% by mid or end 2025. Meanwhile, China's government and central bank launched coordinated monetary and fiscal stimulus with an open-ended commitment to boost growth until the economy improves. In the third quarter, China's GDP growth slowed to 4.6%, making it unlikely the 2024 target of 5% growth will be achieved. However, with the intended stimulus measures, growth is likely to pick up into 2025, helping an earnings recovery in China and, additionally, providing a boost to the global economy. There have been downside inflation surprises across major economies, including the UK, Eurozone, Canada, and New Zealand. Inflation in many developed economies has fallen close to or even below central bank targets. And inflation has also been falling back to target in the US, where concerns over sticky inflation have been the most pronounced. Even without the benefit of lower Fed interest rates, the US economy is growing at a solid pace. GDP growth of 3% annualized was recorded in the second quarter. Growth is being propelled by strong labor markets, elevated consumer confidence, and healthy household finances, while rich company cash flows are powering capital expenditure. The world's major economies have avoided the recession predicted to result from the sharp interest rate increases in 2022 and 2023. In this chart, the Atlanta Fed GDP Now and New York Fed Now forecast indicate that third quarter US GDP growth, which hasn't yet been announced, will be above 3%. The escalation in the Middle East conflict increases the risk of a spike in the oil price, which would significantly weaken both US consumer and business confidence, even though the US is a net energy exporter. The so-called growth tax from an oil spike would be felt even more acutely in Europe, Japan, India, and China, which are all major energy importers. So let's turn now to the global economic and market outlook. First of all, falling interest rates. Interest rate easing cycles, which have begun in all developed economies besides Japan, are expected to continue over the next couple of years. Easing cycles are still at an early stage. The start of the Fed's easing cycle opens the door for other central banks to ease more aggressively. Amongst emerging markets, the number of central banks cutting interest rates has continued to rise, with both South Africa and Indonesia initiating easing cycles in the past quarter. The Bank of Japan stands uniquely in the middle of a tightening cycle, having already exited negative interest rates with a hike of 35 basis points. Only one more rate hike in Japan is expected, probably in December. In this chart, we can see the interest rate, the very steep interest rate increases in the UK, US, and Eurozone between 2022 and earlier this year, or in fact, 2023 were the last rate hikes, and the start of rate cuts. The solid line are the forecasts from capital economics, and the dotted line, the forecasts from interest rate swap futures. Central banks usually cut interest rates to avert recession. This is not the case today. In fact, the world is enjoying a synchronized economic expansion, and company earnings growth is accelerating. So here we've got the 12-month forward earnings on a global basis, and we can see how robust the forward earnings growth forecasts are. Global forward earnings are in a strong uptrend, and momentum, i.e. the year-on-year growth of forward earnings, is picking up. And here I will show you what we mean by that on the graph. So this is the annual percentage change, the year-on-year growth of forward earnings, clearly enjoying an ascending trajectory. So these trends should persist if, as we expect, the global economic expansion persists. Companies across the world are enjoying historically wide profit margins. Productivity growth is improving globally due to increasing capital investment and the benefits of artificial intelligence. In the chart here, we can see the 12-month forward profit margin, and it really is the US that is leading the way. Incredible wide profit margins, above 12% in the US the global ex-US is around 10% lower than the US, but also picking up. Encouragingly, the breadth of global equity market gains has recently broadened beyond just technology shares, and cyclically important sectors such as financials and industrials have continued to move to a series of new highs. The recent broadening in global equity market performance by sector and by region bodes well for further upside. Improved market breadth typically heralds the continuation of a bull market. US equity market valuations are higher than their long-term average and versus the rest of the world, but the premium is warranted. The US economy has a greater capacity for innovation and is home to the world's AI, artificial intelligence champions. The US mega-cap technology shares, in fact, are cheap compared with the valuations of the market leaders during the dot-com boom. The stage is set for a similar boom to emerge over the next couple of years amid strong earnings growth and growing enthusiasm for the AI theme. Oil prices have remained relatively calm despite the growing severity of the Middle East conflict. Oil and natural gas prices have remained at their low end of the trading ranges and are supportive of growth. So in the graph we can see Brent crude oil prices over the last 2.5 years, and we can see that evidence of low energy prices. The weakness in energy prices reflects plentiful supply. Iran, at the nexus of the Middle East conflict, is only responsible for about 4% of global oil output, while other major producers are sitting on significant amounts of untapped capacity. Saudi Arabia is currently producing 8 million barrels per day against a production capacity of 12 million barrels per day, giving it scope to meet potential global production shortfalls. Another geopolitical risk is the US election outcome and uncertainty over the outcome. The policy outcome of a second Trump presidency is also a perceived risk to financial markets. His pledges relating to tariffs and immigration would have the effect of lifting inflation and slowing economic growth. However, Trump prefers a strong economy and a strong equity market. Thus, he has little incentive of risking an escalating trade war. If elected, he would likely use his election pledges, which are extreme, as a negotiating tactic rather than an intended policy direction. So this table shows the projected asset class returns between now and the end of 2024 and over 2025. We expect stock markets to keep making strong gains, at least for the next 12 to 15 months, amid strong earnings growth, falling interest rates, and a broadening in performance across sectors and regions. So here we have bonds, slightly negative returns across different bond markets between now and the end of 2024, but in 2025, fairly decent returns from bonds after the horrendous last couple of years. And this is because, of course, interest rate cycles will be in full swing in 2025. With equity markets, slender gains, but nonetheless still very decent between now and the end of the year. And then in 2025, really very solid, high double-digit returns across the major equity market regions. And energy, very subdued, some possibility of higher energy prices between now and the end of the year, depending on the Middle East crisis, but very subdued oil price in 2025. Equally, industrial metals, more or less flat over the next 12 to 15 months. So let's look at the OAM global portfolios. First of all, the Overberg Asset Management investment positioning. Investment companies, which form the basis of our global portfolios and have done over the last 22 years, still trade at unusually wide discounts to net asset value, or NAV, although they have been steadily narrowing since hitting the historic low of 17% last year. The narrowing is expected to continue while the equity bull market endures. Portfolios enjoy a large core weighting in US equities, which we expect will outperform over the next 12 to 15 months, helped by a widening productivity gap with the rest of the world and continued enthusiasm for the AI theme. Portfolios are complemented with exposure to more cyclical regions, which will benefit from the expected broadening in global economic activity. These regions include the UK, Europe, Japan, and the Far East. They trade at compelling valuations, especially relative to the US. As well as being diversified across regions and currencies, portfolios are diversified across asset classes, with exposure to our best ideas in listed equities, private equity, bonds and credit instruments, infrastructure, and hedging strategies. The equal split between growth and value investments serves to make portfolios even more robust. Overberg Asset Management, OAM, has a long track record in managing global private share portfolios. Over 21 years, £100 invested in 2003 would now be worth close to £500. It has not been a straight line, but as the adage goes, it is not timing the market that compounds investment returns, but time in the market. The annualized return in pound sterling is just under 7% for our global growth portfolio, and in rand terms, 9.3%. So there's the 7%, there's the 9.3%, and that is net of all fees. Asset allocation and global allocation is diversified across asset classes, regions, and currencies. It is truly global multi-asset class portfolio management. Moving now to the global balanced portfolio, shows a similar trajectory, although due to its lower equity exposure, has a somewhat lower volatility and a different endpoint. The balanced portfolio annualized return is in fact slightly above that of the growth portfolio due to the unusually strong returns in the bond market over the bulk of the past 20 years. So let's now finish off with the summary. The global economy is strengthening. In its latest report, the OECD says the global economy is turning a corner amid ongoing growth momentum. Stimulus is in full swing. Central bank monetary easing has begun, but is still at an early stage, while China, the world's second largest economy, is implementing massive fiscal stimulus. Earnings growth plus stimulus equals strong markets. The backdrop of accelerating earnings combined with monetary and fiscal stimulus is emphatically positive for equity markets. Global equity markets are poised for 20% gains. Global equity markets are expected to return around 20 to 25%, depending on the region, between now and the end of next year. Market performance is broadening. Market performance is broadening across regions and industrial sectors, which bodes well for a continuation of the bull market in equities. And finally, key risk events will have a temporary effect. As always, there are risk events which we are keeping a close eye on, but the impact of these would be temporary, because in the end, it is earnings growth that guide markets higher, and earnings growth is unlikely to be affected.
Well, thank you very much for that, Nick. I think there's a lot to be optimistic about. I think where it sounds like the markets are behaving itself and a lot to look forward to next year. Now, next up, we've got the Q&A discussion. So we've got a few questions sent in from our wealth managers and our clients, and we're going to go through those now. So Nick, first up, if we look at the start of the last quarter, there was a significant sell-off in global markets. I suppose it's good to look at, where we've come from if we want to chart a path into next year. So can you explain a little bit what happened in early August?
Thank you, Carel. Yes, you're quite right. There was a very sharp sell-off in August, and that was primarily triggered by disappointment over a few weeks of US economic data, and also an interest rate hike from the Bank of Japan, which we mentioned earlier. And that interest rate hike prompted many investors to unwind their yen carry trades. The Bank of Japan lifted its key interest rates from 0. To 0.25%, putting pressure on investors who had borrowed yen to invest in higher yield currencies to close their positions.
Okay, thank you. Now, in your presentation, we spoke about the S&P hitting new record highs. So we obviously know that after that early disappointment in August, things recovered quite quickly. Can you tell us what were the key factors contributing to this recovery?
So the main one was earnings growth. And as mentioned earlier, it's bull markets go up as long as earnings are growing. And in the US, the S&P 500, which is the US equity market benchmark, second quarter earnings grew by an impressive 13% year on year, up from 8% growth in the first quarter. And that earnings growth surpassed expectations. Approximately 80% of companies exceeded their earnings forecasts. And the promise of lower interest rates also helped restore investor confidence.
Well, talking about interest rates, We've seen from the chart in your presentation that most of the developed markets or economies has embarked on a rate easing cycle. I think the only exception there is Bank of Japan. What impact has this had on financial markets and the broader economy?
It's a very, very good or powerful tonic to market optimism, market pricing, and economic activity when interest rates are lowered, and none more so than when the Federal Reserve Bank cuts interest rates, being the largest reserve bank or in charge of the world's reserve currency. So whatever happens in the US really affects the rest of the world. And the Fed initiated its monetary easing cycle with a larger than expected, significant 0.5 percentage point rate cut. And that was its first reduction since March 2020. Now, the start of Fed easing has normally in the past coincided with recessionary conditions. Yet this easing cycle is more reminiscent of the last time the Fed eased into an expanding economy, and that was in the second half of the 1990s. The similarities between now and then are striking. Then the economy was undergoing a huge technology boom with the internet revolution and versus the AI revolution that we have today. There was a surge in labor productivity, as there is today, and continued disinflation, again, as there is today. During the 1990s period, stock markets surged. When coupled with a recession, interest rate easing cycles have been followed by falling stock prices, but the opposite has been the case. Whenever the first Fed rate cut did not precede a recession. We expect markets to continue making strong gains over the next year or so in the US and more broadly as a cyclical recovery catches hold in other regions.
Thanks, Nick. Last question, US politics. We're days away from the US presidential election. I don't think you can open a news app without reading something about the US presidential elections coming up. And I think the polls are seesawing between Harris and Trump. How do you see this affecting the market outlook?
Yeah, Carel, I suspected you might be asking this question. The polls are fluctuating from day to day. And as ever, the media likes to allocate or attribute market volatility to one reason or another. And the scapegoat at the moment is concern, anxiety over the outcome of the US presidential election. It's certainly seen as a potential risk to the favorable market outlook. Both candidates have proposed radical economic policies that may influence inflation and market behavior. Nevertheless, analysts agree on one thing, and that is that factors like earnings growth and Fed monetary policy are far more significant than the election outcome. Indeed, historically, the US equity markets have performed well during election years, regardless of which party wins the election. And again, just want to stress that it's all about earnings growth, and that's what guides markets in the end.
Thanks, Nick. Some sage advice there. I think cut through the noise and keep analyzing the basics, and I think that's really where the truth lies. That's it for the Q&A session. If any listeners have any questions, please reach out to your wealth manager or get hold of us at info@overberg.biz. Yeah, I think there's a lot to be optimistic about despite some challenges, but I'm looking forward to a solid end to this year and also some good gains in the year ahead. That's it from us. Thank you, Nick, for presenting. Thank you to our listeners and viewers. We'll see you next quarter.